Hello and welcome to this podcast. This podcast is the last in a series in which we examine the general definition of gross income. So far we've established that South African tax residents include their worldwide income, whereas non-residents include only their South African source income, and we've established that in order for there to be gross income, you need an amount, in cash or otherwise, that has been received by or accrued to the taxpayer. In this final podcast, we look at the final criteria, which is that the amount must not be capital in nature. There's no definition of capital in the Income Tax Act, and as a result, it's been the most fiercely contested of the criteria within the gross income definition. It's important to say that all amounts must be either capital or revenue. There's nothing else within the gross income definition. And whether something is capital or revenue is a subjective item. It's determined by the taxpayer's intention. You can't simply say that all of a particular kind of asset are capital and all of other kinds of assets are revenue. Now, prior to 2001, if an amount was capital in nature, it was excluded from gross income and there were no further tax consequences. With the introduction of capital gains tax in 2001, we must now think about amounts excluded from the gross income definition and what the capital gains tax consequences of those amounts are. In Pyatt, the court clarified that there's no halfway house between capital and revenue. An amount must be one or the other. It is, however, possible to say that a single amount received represents part capital and part revenue. There's two questions we now need to answer. First is, what is capital? How is it defined? And the second is, how do we determine whether something is capital or revenue in a particular context? So we'll begin with, what does capital mean? And the overarching definition that we can extract from case law is that capital produces either revenue or benefits. The most commonly given analogy is that of a tree and its fruit, and that comes from CIR versus Fisher. And the analogy is that a tree produces fruit in the same way that capital produces revenue. You don't plant a tree because you want a tree, you plant a tree because you want to get the fruit. In the same way, a capital asset is not pursued for its own sake, it's pursued for the revenue that it will bring in. In CIR versus George Forest Timber, they were talking about the balance sheet, and they said within the balance sheet we've got fixed capital and floating capital. Fixed capital is that capital that goes onto the balance sheet once and remains there. Buildings and machinery, things that are used in the business. Floating capital is that which gets recycled over and over again. So money buys trading stock. Trading stock leads to sales. Sales lead to money in the bank. That money is used to buy more trading stock. It gets frequently recycled, and that is floating capital, which is revenue in nature. Then in W.J. Verriebelachens, they said that capital represents the income earning structure, whereas revenue is the result of the use of that structure. In Verriebelachens, the company owned a hotel and they secured a contract with a foreign government to provide an extended period of accommodation. That contract was then cancelled and Verriebelachens sued for compensation, which they then received. They then argued that the amount represented capital. The compensation that they received was capital. And the court said it's not capital because the income earning structure of your business is the hotel. It's the hotel that leads to your future revenue. What you're in fact being compensated for is the lost revenue which your hotel would have produced. So that's the definition of what capital is and what it isn't. The question is now, in a particular transaction, is the income capital or not? The primary case for determining capital revenue is Stott. And in Stott, the court said the determining factor is the intention of the taxpayer when they acquired the asset, which they've now obviously sold and which has led to income, their intention at the date that they purchased the asset, and whether there was any subsequent change of intention between purchasing the asset and selling the asset. Now obviously there must be some change in intention insofar as they've at least decided no longer to hold the asset anymore, and presumably no longer to generate revenue from the asset. But going down a few cases, in John Bell & Co., they said that we must identify something more than merely a decision to sell in order for there to be a change in intention. Now, it is possible to have more than one intention at the point that you acquire an asset or during the period that you hold an asset. And in COT versus Levi, they said in that case we look for what is the dominant intention. So for example, you might buy a property because you like the prospect of the rental income that it could generate. At the same time, you might be aware that the price of the property is likely to increase, and at the point that you decide to sell it, that you could make a profit on the sale. Those are both intentions with which you enter into the purchase contract. Determining whether the subsequent sale of that property is capital or revenue is determined by which was your dominant intention. Were you really after the rentals and you sold it as an afterthought, or were you really after the profit on sale and you were just renting it out in the meantime? So we can have two kinds of intention: capital intention and revenue intention. And in CIR versus Pick and Pay Employee Share Purchase Trust, the court clarified what a revenue intention is, and they said it's a scheme of profit making. It is a taxpayer that deals with the asset in question in a way that indicates it is the trading stock of that taxpayer. So in CIR versus Pick and Pay Employee Share Purchase Trust, the trust purchased shares for its employees, or for the employees of Pick and Pay, and they purchased those shares when the employees became entitled to them, and they had to sell those shares at the point that the employees resigned or retired. During the course of their operations, they made considerable profits. They were buying shares and then they were selling them. And the question was whether the profit on sale of those shares was capital or revenue in nature. And Pick and Pay Employee Share Purchase Trust successfully argued that what they were conducting was not a scheme of profit making. The shares were not their trading stock. And they argued this because they said that they didn't buy the shares when the price was low, and they didn't sell the shares when the price was high. They bought the shares when the employees became entitled to them, and they sold them when the employees resigned. The fact may have been that those transactions led to profits, but it was not the intention of the trust to trade in order to generate those profits. They were just following what the employees were entitled to. So Pick and Pay Employees Share Purchase Trust was not a scheme of profit making, but it shows us what a scheme of profit making is. On the other hand, in Stott, they said that the disposal of an asset that remains capital intention is one in which the taxpayer is merely realizing their asset to their best advantage. In other words, if a taxpayer decides to sell a capital asset, they are perfectly entitled to sell it at a profit, and they are perfectly entitled to do what is necessary to that asset in order to make as much profit as possible. So if a repainted house will sell for more than a house that hasn't been repainted in some time, a taxpayer is entitled to repaint the house without that action making it a scheme of profit making. Similarly, you're entitled to sell the asset in whatever means is most profitable. You're also entitled to advertise the sale or intended sale. You're entitled to generate whatever profit you can. At some point, however, you could enter into a scheme of profit making. Now, some taxpayers may have started out in a scheme of profit making all along, so we're not really worried about whether they are changing their intention. But other taxpayers might have started with a capital intention and subsequently had this change of intention that they talked about in Stott. And one case in which this happened was the case of Natal Estates. Natal Estates was a farming company. They farmed sugar and they had considerable plantations. And that was their intention, but at the same time they were aware that the demand for land was likely to increase. And at some point they decided that they could make more money by selling the land than they could by continuing to farm sugar on the land. So they decided to sell the land, much like Stott did. But the actions that they took were considerably more than those of Stott. So they subdivided the land into smaller plots, which, to be fair, Stott had done as well. They also cleared the land of the sugar plantations. They had the land rezoned. They had the land renamed. They developed a number of holiday destinations on these bits of land that they had. They also built example holiday houses, kind of thing that would entice buyers to buy and build similar houses. They also went on a considerable marketing campaign, and all in all, the court ruled that what they had done was convert their land into trading stock. Their subsequent actions were no different from those of a land developer, someone who would have bought land with the intention all along of developing it and selling it. And in fact, the court said that they had never seen a land development case with as much action that had ever been argued was still capital in nature. And the court said, the sum of your actions indicates that you've crossed the Rubicon. You have reached that point of no return where you have left the intention of capital and you have entered into the intention of revenue or trading stock. So when we're looking at a case, we need to look at a case that is initially clearly capital and say, is the sale of that asset merely realizing the asset to its best advantage, or has the taxpayer crossed the Rubicon and entered into a scheme of profit making? And the respective actions of Stott and Natal Estates give us an indication of what each set of actions looks like. When we're considering companies and a change of intention, there are two interesting cases that have arisen. One is that of Berea West Estates, and the other is that of Elandsheuvel Farming. In Berea West Estates, there were a number of beneficiaries in a will, and those beneficiaries were collectively entitled to the proceeds on disposal of the land of the deceased. However, it was going to take some time to wrap up this disposal, so what the executors decided to do was to form a new company. That company would buy the land from the beneficiaries of the will. They would then sell that land, and as and when they sold the land, they would distribute the proceeds to the beneficiaries who are now shareholders in this new company. So the company bought the land with the intention of selling it. Normally that's revenue in nature. However, the court in this example said that all the company was doing was continuing the intention of the original beneficiaries. And so the intention of the beneficiaries was imputed onto this company, which continued this set of actions. And this kind of company is commonly referred to as a realization company. In contrast, in Elandsheuvel Farming, Elandsheuvel was a farming company, and at some point the shareholding in the company changed. The existing directors who were farmers left the company and new directors were appointed. These new directors were land developers. The new directors then proceeded to develop the land and sell it off at a profit. And in that example, the court held that the change of directors brought with the new directors a new intention. Now, some commentators have said that that is overly harsh, that in determining the intention of directors, we shouldn't look at their past actions, we should look only at their actions with respect to the current company that is under consideration. Be that as it may, in Elandsheuvel Farming, they looked at the change of directors and determined that that could represent a change of intention. So intention maybe is a difficult thing to establish, and the question is, how would we determine a taxpayer's intention? Well, first of all, it's important to say that the onus of determining the taxpayer's intention or proving the taxpayer's intention rests with the taxpayer. That used to be Section 82 of the Income Tax Act. It's now Section 102 of the Tax Administration Act. What that means is that If the transaction appears that it may be revenue, SARS is entitled to treat it as revenue, and it rests on the taxpayer to prove that it's capital. Now, the factors that might be considered in determining the taxpayer's intention include the following. None of these is decisive, but together they would be weighed in determining the taxpayer's intention. The first, in Milan versus KBI, the court said that we would look at what the taxpayer's stated intention was. We would look at his or her ipse dixit, what he himself says. That's not to say that the taxpayer can say whatever they want and that will automatically be the result, but it is a consideration. The court also said that they wouldn't take that statement lightly, but they would then scrutinize and examine it. That's fine for individuals who are natural persons, but what happens in the case of taxpayers that are companies? Well, in CIR versus Richmond Estates, the court said that we would look at the action of directors in their capacity as directors, and those actions would inform the intention of the company. Interestingly, in CIR versus Richmond Estates, this is an example of where the company started with a revenue intention, i.e. they bought land with the intention of selling it, and subsequently changed their intention to a capital intention. They changed their mind and they started holding the land or the property with the intention of renting it out. They rented it out for some period and then they sold it. The court was satisfied that that sale remained capital. We would also consider the length of time which the taxpayer has held the asset. An asset that is bought and sold quickly is more likely to be revenue than an asset that is bought and then held for an extended period of time before it's sold. We would also look at the frequency of similar transactions entered into by the taxpayer. If the taxpayer routinely buys and sells the asset in question, then it's more likely that that transaction is revenue in nature. If it's the first time they've done it, that suggests that it might be capital. However, in Stefan versus CIR, the court did say that if all the remaining evidence points to a transaction being revenue in nature, the taxpayer can't, as their defense, say that this is the first time they've entered into the transaction. It's not that the first transaction is automatically capital, but the more frequent there are similar transactions, the more likely they are to be revenue. We would also look at the nature of the taxpayer's business. Is this transaction closely linked to what they normally do? Do they routinely buy and sell houses? Well, if they do, then the sale of this particular house is more likely to be revenue in nature. But if it's quite separate from their regular business, may be more likely to be able to argue that it's capital in nature. We would also look and see what income stream had arisen from the period in which they held the asset. If the taxpayer is arguing that the asset is their tree, then logically we would say, where is the fruit? If there's no fruit, it seems like it might be their trading stock. We would also look at the reason for the sale. If the taxpayer is able to convince the court that there was some reason other than the pursuance of profit that motivated their sale, then it's more likely to be capital in nature. In CIR versus Nell owned Krugerrands, and he sold some of the Krugerrands in order to purchase a car for his wife. And he was able to convince the court that the reason he sold them was not in order to make a profit, but because he needed to raise the money to buy the car. However, in CIR versus Nussbaum, Mr. Nussbaum was the owner of a portfolio of shares. His stated intention in the portfolio was to own the shares in order to generate dividend income. And he stated that he only bought shares when they appeared to be paying a good dividend stream, and he sold shares when the dividends seemed to be drying up, or when it was a low dividend yield compared to the market price. The court looked at the frequency of the transactions and the history of the transactions, and they decided that in almost all transactions, Nussbaum bought shares at a low price, sold them at a much higher price. And they said that the motivation for his sales seemed to be the difference between selling price and original buying price. And they said that was enough for him to have a secondary business of share dealing. And the proceeds on disposal of those shares were considered revenue. We would also look at the manner in which the asset is financed. If the asset is financed through long-term financing, it's more likely to be capital in nature, or certainly it supports a capital intention as stated by the taxpayer. If, however, it's bought with money that needs to be quickly repaid, then it's unlikely that the taxpayer could hold that asset as capital. And finally, we'd also consider the nature of the asset. Is it the kind of asset that you could use to generate revenue or benefits? Or is it the kind of asset that is typically trading stock? Now, we did say that one person's capital asset could be another person's revenue asset, but some kinds of assets lend themselves more to one intention than they do to the other. So those are the factors that the court would consider. That's it for the general definition of gross income. But now, following the general definition, there are a number of special inclusions for items that don't meet all of the principles in the general definition, but it's been determined that those amounts should be included in gross income. So the next podcast is going to deal with that. Thanks for watching.